Why is the federal funds rate key to the Fed's monetary policy? Imagine a tiny interest rate that can influence the entire economy. That's what the federal funds rate does. It might seem small, but its effects are enormous. The federal funds rate is the interest rate banks charge each other for overnight loans of reserve balances. These reserves are the money banks keep at the Federal Reserve to meet regulations and handle daily transactions. The Federal Reserve, or the Fed, sets a target range for this rate through its policy meetings. They do this to influence how much banks pay to borrow reserves. When the Fed raises this rate, borrowing becomes more expensive for banks. Banks then pass on these higher costs to consumers and businesses through higher interest rates on loans, mortgages, credit cards, and auto loans. This usually slows down spending and investment, helping to control inflation. When the Fed lowers the rate, borrowing costs drop. Cheaper loans encourage more spending and investment, which can boost economic growth and lower unemployment. The federal funds rate acts as a benchmark for many other interest rates in the economy. For example, mortgage rates and business loans are often tied to it. Changes in this rate ripple through the economy, affecting how much people and companies borrow and spend. This makes it a powerful tool for managing economic activity. The Fed uses this rate to help reach its goals of maximum employment and stable prices. By adjusting the rate, the Fed can cool down an overheating economy or give it a boost when growth slows. The rate also signals the Fed's view of the economy's health, guiding expectations for markets, businesses, and households. The Federal Reserve meets regularly to review economic data and decide whether to raise, lower, or keep the rate steady. These decisions help smooth out economic ups and downs, aiming to keep growth steady and inflation in check. Because of its influence on borrowing costs and economic activity, the federal funds rate is a key part of the Fed's policy toolkit. It's how the central bank guides the economy toward stability and growth.